Okay, good evening, everyone, and welcome to the Global Market Outlook. This is the third quarter review. We're going to chat through the usual. We're going to look at the broader economic picture, what's happening in financial markets. We're going to review the global equity portfolio, have a look at what's going on underneath, and then we're going to chat about some investment ideas. And then, of course, the whole point of a webinar. You get to do Q&A as well. So any questions, just feel free to hit it in the chat box or the Q&A section. I might leave them until the end. I might answer them as we go. It depends kind of on the content and if it works. So before we get started, I know you guys are not really interested in a business update, but we've been adding a lot of new people to the team recently. You'll see Sean and Brett are up there now as well. Looking forward to getting some webinars from them as well. Today's presentation is really about kind of the second part of our business, which is managed solutions. Obviously, we run the global equity portfolio. Viv runs which I'm the portfolio manager of, and Viv runs the artificial intelligence portfolio, which I just can't beat at the moment. And then, of course, also structured products falls under this vertical as well. These products that we're going to talk about today and kind of the outlook that we talk about today, it really is to support investors in these products. And I think it's important to make a distinction between these products and the wealth and advisory services. The way that the managed products work is we construct different portfolios for very specific outcomes. I'm going to take you through global equity tonight. But we're not looking at you as a person. We're just saying that this is what the product does, and it's our job to make sure it does exactly what it says on the tin. If you're looking for that holistic advice, that's really wealth and advisory. Chat to Kyle. We've also got a new CFP coming in as well. And they'll take you through, putting it in the context of your overall investment plan. And that is incredibly important. Of course, we've got a lot of securities broking clients on these as well, because we do give away a couple of stock picks, and we do kind of look at technical levels and broader economic themes as well, which, if you are a self-directed trader, generally does help feed into your thinking and hopefully acts as a sounding board for the way that you are tackling very uncertain financial markets at this stage. Obviously, in our business, the only thing I'll add to this slide is we're very happy to have, for many years, been ranked the top securities broker. We were ranked this year, and I'm very proud of it, as the top boutique wealth manager as well for the first time ever. So, definitely pushing hard into the wealth, the more holistic investment advice. And I think part of it is that there's some very interesting products that we're building in managed solutions at the moment that you'll probably see coming early 2026. Everything from we vetting, kind of like a private equity unlisted AMC, which I think is going to give you guys interesting access into the unlisted space, and a whole lot of other things that we kind of are in earlier stages of development. So I'm kind of particularly optimistic about what's going to be happening in the next couple of months. Tonight we're talking markets, we're talking investments, and we'll leave those for another day. So what's happened over the last 3 months since we last met? And it's been an interesting ride. And I was trying to pick out like the key themes in markets. And as you can see, I think we still, like, one of the absolute, I suppose, most obvious things that's happening in financial markets at the moment is that we have this very concentrated rally in large cap stocks. And you can see it, as I said, we normally give away a stock pick, or we discuss position moves in the portfolio. In the last presentation, I kind of gave you my thesis on Google. At that stage, I think Alphabet was trading at it's sub 20. It was like an 18.5, 19 times earnings. Kind of took you through the whole investment thesis on it. Said, this is a screaming buy. We run a ranking model whenever we select stocks. It's still ranking right up there. And in the last 3 months, it's delivered 40%. So hopefully you went out and you bought some Alphabet shares, because you'd be up 40% if that's the case. But looking wider into the market here, you can see that it's not really the broad-based rally that maybe the index is showing you. Obviously the size of these blocks gives you essentially an indication of the market cap of the company, and you can see the big dog in town, Nvidia, up 13% in the last 3 months, Broadcom up around 21, Alphabet up 40, Tesla up 46. this is really driving the returns. But if you look deeper into the S&P 500, you can see there's a lot of little red squares out there as well. This isn't a pure green map that we're looking at the moment. And that's kind of a theme that I'm going to carry through the presentation this evening. So what is happening? That's the one theme is definitely like the concentrated rally that we're seeing. And the other is gold, which is unbelievable. Like the amount of times I've been asked to chat about gold on financial programs in the last couple of weeks is insane. We've got obviously the gold price smashing through $4,000 an ounce, and I think that's really kind of fueled investor appetite. And it kind of highlights for me something that often when you're talking in kind of more formal settings, not on one of our webinars, you kind of always end up talking about the momentum investment of that time. No one wants to hear about the contrarian investment. And I remember, I think gold was probably 1,300, 1,500, somewhere around there. And we were doing it was a business day show. And we were kind of talking, and I said, well, I'm a little bit of a gold bug, I'd like, and I always take clients through, or like always talk about like the three ways you can invest in gold. You can invest in the physical, and that's for people that think like that actually want protection from the financial system collapsing. It's no good buying a gold ETF if you expect the banks aren't going to be functioning. So then you want to have the physical gold. If you think that there's going to be a total political collapse where you've got to put assets in your pockets and duck, then it's physical gold. Of course, if you're just playing the market and you're saying, listen, I think that there's going to be high inflation, interest rates are going to come down anyway, which is kind of the situation that we're sitting in at the moment. ETF is perfect, much simpler to execute into. You can kind of trade in and out of it ungeared. There's all the leverage products around that as well, but you can just buy the gold price as well. And finally, you can buy the gold miners, and the gold miners obviously have that operating leverage in them. They at the moment, their ASICs, which are their all-in sustaining costs, are probably sitting at around 1,500 to 1,800, maybe $2,000 an ounce. Gold price is at 4,000. So they've got these huge margins, and that gives these a big exaggerated stock price movement. So if you're a trader or you're looking for those super normal profits, you're willing to take a little bit of risk or a lot of risk, then the gold miners are the way to play it. And I remember chatting on the show, and I mean, I almost got spat on by the host, and like the other guest was like, come on, Gary, that's for truck drivers. What are you talking about? Like, and I mean, it was a contrarian view at that stage. And now I know everyone is telling me that this is the best thing to have as a diversified hedge in portfolios. And I must say, I'm maybe a little bit more cautious than I have been around, kind of like saying to clients, let's go buy some Krugerrands, or, let's go and take a punt on miners. Because I think what we've seen over the last, what can we say, probably like three or 4 years, is we've seen almost like a de-dollarization. So we've seen a huge amount of central bank buying coming through, specifically from China, but across the globe, replacing some of the dollars that they have on their balance sheets with gold, and that's kind of started the rally. Now you've got you kind of getting to kind of what I think is like almost the midpoint of the rally. Again, no one knows when this is going to end. It could turn around and 4,000 might have been the top handle. I don't think so. I saw Adrian Saville was talking about if you kind of follow monetary policy and the history of monetary policy, he's done a back of the napkin calculation that if we had to go and actually back the US dollar to gold again, given the amount of US dollars now in circulation and the current kind of like store of gold, he would say gold price would have to be at $101,000 an ounce. So then $4,000 doesn't look good. And I don't know where it is, but what I do know is kind of like the conversations that we've been having, and just the feeling of kind of engaging with market participants. And it does seem that yes, I mean, China is absolutely still buying gold, but certainly like we're getting retail interest now as well, like in a big way, and we can feel people coming and asking questions about it. People want to get exposure. You're seeing also, as I said, we engage with kind of professional institutional investors, and they're all saying, oh, we have to have this in this portfolio, and it almost does feel a bit like a FOMO trade. It feels like people are now piling in And that's generally the time that you need to be a little bit more skeptical. I'm not saying that there's not legs in the short run. I'm not saying we can't get to $5,000-$6,000 an ounce, but it does, for me, feel I always kind of position myself more as a contrarian investor. And that performance is generating interest. And that's always, for me, just a little warning bell in the back of my head. But at the same time, what we're seeing in the US at the moment is yeah, I mean, it's absolutely crazy. So right now we have the US government shut down. That's my Washington Post article. Yeah, the US government is not shut down. I mean, normally at this part of the presentation, we start talking about, what economic data is being released from the US. We go, I always time this presentation so it's just after the first Friday of the month so we can have a look at the non-farm payrolls numbers. There were no non-farm payrolls numbers this month because obviously there is no data releases because the US government is currently not functioning correctly. So we're in a weird time in markets where essentially like there's a lot of warning signs for investors, a lot of warning signs. I mean, it's been an interesting year because I think the end of the first quarter presentation, we were in the depths of that Liberation Day sell-off. Everyone was panicking about, what are the tariffs going to mean? Like, what is the impact of tariffs? And that's almost kind of like drifted into, the bottom drawer. People are not as concerned. I mean, I saw there is in all of these articles today, I didn't kind of necessarily pick and choose to be particularly bearish today. They were all actually just going around to the major newspapers and kind of clicking to kind of get a flavor of, what's topical at the moment, what is the press reporting. And they're talking about, obviously, EU steel tariffs at this stage. And I think people are kind of almost like forgetting to an extent, when I say people, like market participants, the impact that some of these tariffs are going to have on the inflationary outlook as well. And, up until now, we haven't really seen it coming through in the data. Now we don't have any data, but I think it's a real concern underneath that, there is going to be a time delay between this. There's going to be a lag in this. I mean, trade patterns are going to have to change. Physical economics doesn't change as fast as financial market pricing changes. And you do get a sense that we had that kind of initial reaction. We had this big recovery. And now we're kind of sitting in a place where you're actually going to start seeing the economic impact filtering into data. And I feel like the financial market is kind of discounting it, saying, oh, well, it's not going to be a big deal. So I think that's kind of like maybe a worrying sign underneath. And then obviously it was crazy how many bearish articles there were today. I mean, we had, AI has carried the stock market. It again goes to a very thin rally that I was talking about earlier, but concerns are mounting about a bubble. America's top banker sounds a warning. That's JB Diamond on the US, for a US stock market fall. IMF chief is saying buckle up for economic uncertainty. So, even kind of like asset managers on CNBC, this was front page of CNBC today. Stock market sugar rush is a good time to purchase protective puts. So you're getting a lot of kind of like quite negative news flow around the markets. And yet, if we look at the Fear and Greed Index, which I always pull this off this year in the insight for the presentation, just to give us a gauge, because it is a really nice, it's a physical gauge, but it also is a really good gauge of sentiment, because I can kind of give you like, the conversations that we have, but they're all anecdotal, whereas it looks at the put-call ratio, it looks at the volatility index, it looks at a whole lot of different measures of sentiment in the market and creates a composite. At the moment, we're actually neutral. It's neither extreme greed or extreme fear. And I can say, I feel like the market is that index, while we're not seeing it in the kind of more formal quantitative metrics, qualitatively, I can tell you, I feel like I don't know if it's because I'm reading all these news headlines, but it's also kind of the client engagements that we have. I mean, I remember, post 2008, I mean, you couldn't beg someone to buy an equity. Everyone was absolutely shell-shocked after 2008. And it was 3 years of just grinding higher as people didn't want to get invested. And it was all about protecting downside. And it was kind of like that fear trade more than anything else. I can feel now that the conversations with clients are very different. It's how can I make more money? I've made this money, but I need to make more money faster. And it's kind of like a weird shift for me as well. It's kind of the second little alarm bell that's kind of going off in my head at the moment. But at the same time, yeah, like I said, it is neutral, and we have had the Fed now cut interest rates for the first time this year. And yeah, I mean, Fed officials are now looking at, yeah, they're worried about inflation, but the Fed, of course, has a dual mandate. They look at inflation, they want to keep the average price level, from increasing erratically. They have a 2% target, but they are now also clearly focusing on the growth mandate as well. And if we look at the US economic data, as I said, this is going to be a month back now because like it hasn't been, the latest figures haven't been released. But we have seen that US unemployment is trending slightly higher since 2023. You can clearly see that this is moving up. We've now ticked up to 4.3% unemployment. Now, while you have seen kind of like a slight weakening in the labor market in the US, 4.3% is not unusual by any stretch of the imagination. If we were talking 10, probably like, yeah, I'd say 10 years ago, 10 years ago, 4.3% would have been considered frictional unemployment. Absolutely. It would have just been the average. An economy is adjusting and certain people need to change jobs. And when they change jobs, they are classed as unemployed because they're looking for work, but they don't have work. And you always expect a frictional level of unemployment in the economy. Of course, then the US actually, went all the way into the threes, and it kind of almost set a new precedent, and people looked at it and went, oh, well, now we clearly see the frictional unemployment is actually lower than that. So 4.3% in itself is nothing to worry about, certainly not from my perspective. But you can definitely feel from kind of like Fed officials that this is going to be a focus. And if we look at the US labor market at the moment, I mean, we are going into, I think the next 5 years is going to be incredibly disruptive. I mean, we've got incredible technology coming through. Labor markets are going to be in flux. They talk about, I mean, I always go back to the Keynes example where everyone goes, oh, but there's going to be no work and no jobs, and people are going to be unemployed because the robots are going to do everything, and your AI tools are going to do everything for you. The same was kind of believed, when the conveyor belt was invented, and everyone said, oh, well, we're only going to work, 2 or 3 hours a day for the pleasure of working, and we'll only work 4 days a week. And we all know how that turned out. It just doesn't materialize. And what's going to happen with more advanced tools and with a change in society, from my belief anyway, is we're all just going to be expected to produce that much more. It's going to be a productivity increase, not necessarily that we're all going to get to work less, unfortunately. But who knows? I mean, I do think that there's going to be huge fluctuations in the US labor market and the global labor force as well. So at 4.3%, I wouldn't read too much into it. But what I would read into it is that the Fed is clearly now focusing on growth. They're taking that unemployment number. They're saying it's getting a little bit weaker. The labor market is a concern, and we're going to start cutting interest rates more aggressively. As you can see from the little tail down here, we've had our first 25 basis point cut. I really thought the South African Reserve Bank would follow suit. I mean, at the moment, if you look at our 10-year or 20-year, I mean, we're up in kind of like the nines and tens in terms of interest rate. Our inflation rate is 3.3%. Okay, it's official. I know everyone's going to say, but wait, my inflation basket doesn't feel like that. But that's kind of the official rate. We have a huge real return locally, and it did look like there was room for the South African Reserve Bank to give us a little bit of relief. Unfortunately, they held steady, and I thought after the Fed cut 25 basis points, we become relatively more attractive, which is one of the explanations of why we're just seeing this currency being so strong at the moment. So I thought there was room to cut, but it also, like our Reserve Bank has a very different, I suppose, view of what's happening. They're looking at it and they're saying a lot of our issues are structural. Monetary policy can remain more restrictive in South Africa because inflation is it's not a demand pull, it's more cost push. And And yeah, and unfortunately, they didn't cut interest rates for in the local market, but offshore we've had the first cut, and it does look like we're going to get another two cuts towards the end of the year. When we came into the year, three was kind of like the midpoint. When me and Viv had to do our predictions for the year, three was kind of like what the market was expecting. So we had to go overweight or underweight that. We only have two Fed meetings left for the year. So we've got 29th of October and then the December meeting. And it does look like the pricing is for overwhelming probability that they will cut 25 basis points and then 25 basis points again. What does that mean? It means that it should actually be quite supportive of stocks, equity markets, and specifically growth stocks. So while we have seen this rip-roaring rally in AI and anything associated with chip makers or anything to do with AI has run hard, these are also growth companies. So in the shorter run, you would expect with lower interest rates, that kind of you do your time value of money calculation, your discount rate is lower. You can price, naturally you would price a stock more aggressively for future growth as well. So yeah, it's actually quite good news. Now the question is how much of this has already been priced into the market, and that's where the art and science comes in. In terms of inflation in the US, inflation is still well above the long run target of the Fed. The Fed looks at PCE, these are CPI figures, but inflation is still persistently high. Yet the Fed is kind of deviating away from it. And I think that's one of the reasons that you're also seeing the rally that we're seeing in gold. If you've got an environment where you expect this devaluation of the dollar, and the dollar index when we came into the year we were coming in through a Trump inauguration in November. Everyone was at least Trump win in November. Everyone was very excited. Like when I say excited, they were excited from a deregulation point of view, market friendly. He's going to help business, and stocks are going to go much higher. And there was kind of like this almost feeling of price to perfection before we started messing around with tariffs and all sorts of other nonsense. But um, but yeah, at that stage, dollar index was very strong, and now it's almost like the picture's becoming clear. I remember at the beginning of the year, I said 110. I think a lot of the optimism around the Republican White House is probably priced into the dollar already, and we thought that the dollar was going to fall. The dollar index has fallen back. I mean, year to date, against its six major trading partners, I think we're down around 10%. So that's a significant move for the US dollar, like in terms of weakness. It's also the other side of the rand dollar pair. So while I talked a little bit about the carry trade earlier, where you had essentially the Reserve Bank not cutting interest rates and the Fed cutting interest rates. What does that mean? It means that, hey, wait, I can park my cash and get an extra 0.25% in South Africa, and you typically see money flow towards the higher yield. Because we're relatively more attractive as a destination, and that essentially forces our currency a little bit stronger. But where we are now, I mean, how much of this has been priced in already? It's very difficult to say. But I mean, we have had obviously like a severe dollar weakening, and that's kind of forcing up gold as well. So inflation, we're sitting in an environment where we've got a Fed that's going to be cutting interest rates. Interest rates are going to be coming down. That makes gold more attractive. You've also got a situation where inflation is going to come into the system, and gold, of course, is an inflation hedge, but then so are stocks. So is anything physical. They talk about it, it's like property prices are kind of hitting record highs in the US, that is. Stocks are at record highs, gold is at record highs, everything is at record highs. And then you start to think about it, you're like, actually, the picture is being muddied by this much weaker dollar. Everything that you price in dollars looks like it's run really hard when the dollar is weakening. And what we've had for the last 3 months is kind of like a significant dollar weakening. US GDP growth rates kind of toddling along. It's not hitting that kind of 3% level where we expect. We were chatting in our research meeting this morning. If AI is to be real, and to justify the spend that is going into AI at the moment, we need AGI, and to know that we have it, and we know that these tools are working, we need to see in the next couple of years, we're going to need to see GDP growth rates at like 5% in the US. That will justify the spending. 2.5 isn't going to cut it. 2.5 is backward looking, however. So nothing to worry about yet, but it's just kind of where the expectation of US GDP growth needs to go to justify the artificial intelligence infrastructure rollout that we've seen so far. So that's kind of the picture of their, like I say, data dependent is the headline here because the Fed is data dependent. So what's going to happen with the Fed? Well, we can't get the data. We're going to have to look for the data elsewhere. But current pricing as of today, so this is out to the December meeting, there's an 80% chance we'll get both cuts. There's like a 97% chance they'll cut yeah, I think it's 29th of October. In December, we should get in the second cut. But by the December meeting, at the end of the December meeting, we should be another 0.5% lower in the US. So interest rates down should be good for stocks, should be good for everything, should be bad for the US dollar. And then we would expect a continued weakening. I don't have a dollar index chart up for you guys today, but if you go and have a look at it, it's DXY is the ticker. I'm sure you can pull it up on the internet. You'll see that historically the dollar has weakened against, again, this is against its 6 major trading partners, all the way down to around 90. And I mean, we're sitting at like kind of 97 at the moment. So there could be still significant dollar weakness yet to come. So, if you are, and does that mean now, okay, so just to take a step back, does that mean if you're invested in dollar priced assets, that's a bad thing for you? No, not at all. Remember, what you ultimately invest in is what you invest in. If you're sitting on dollar cash, unfortunately, like I am on in my personal name at the moment, it sucks. It really sucks because the dollar is devaluing and can potentially devalue more. But if you're in an investment asset, whether it's a US equity, a European equity that's dollar priced, whether you've bought something physical like gold, whether you've bought a property in the US, the dollar is weakening, you own that asset. Just because it's referenced in dollars doesn't matter. So I think that's also something key to understand, that if you have got an offshore account and it's dollar-based and you're worried about the dollar, you don't need to be worried about the dollar. You need to focus on what your underlying investment actually is. If you're focusing on that, you'll be absolutely fine. So looking at the currency, we always do a currency chart. And like I said, like we kind of look at the technicals, we look at the fundamentals as well, just on Rand dollar. This kind of feeds into our FX business. We obviously do foreign exchange for clients. I'm also happy to say we've done quite a few of, obviously with the strengthening in the currency, we've done quite a few of the AIT pins recently. I've chatted to you guys about it before, in terms of, like when South Africa was kind of everyone was very nervous. It was like everyone's very optimistic about South Africa now, but when they were very nervous, people were saying, oh, but are they going to take away our offshore allowances? And I remember even saying at that stage, that's from all the engagements we have with the Reserve Bank, that's absolutely not the case. They're actually going the other way. It used to be a 4 million allowance, now it's 10, and that kind of covers most people, and you can always do the special Reserve Bank applications as well. But I mean, the tax clearances that we're doing for clients at the moment, I literally did one the other day. I think, they reserve, I think it's 21 working days before they reply, and then they can ask for additional documents. I think we got it approved in 7 working days, and they just come through now like this. So if you are looking to move a 10 million, I can tell you, like, SARS, I think once they moved from that old FIA process to the AIT PIN process, is running really seamlessly at SARS. So it's actually quite a simple application, and they're getting approved very quickly these days. So that's optimistic. And like I said, with the currency strength that we've seen at the moment, like we have had a little bit of demand for that at the moment. But where is the currency going to go now? Is now a good time to take money offshore? Is it a good time to bring back? If you're a short-term trader and you want to trade the US dollar ZAR pair, should we be going long? Should we be going short? How should we be thinking about this? So I always look at the technical picture because it's a currency. It's super, super liquid. It's super efficient. You kind of have to believe in the efficient market hypothesis around something like this. You don't really get like big mispricings in currency when you have just such huge volume and so many people looking at it all the time. Kind of like that. I believe it in that it's pretty efficient market. Yeah, so technicals work because like everyone's kind of looking at the same thing as well. We can see we had a kind of a strengthening trend. We had this big weakening trend, and I mean it's insane to think that in April, not in April, but like I mean we were almost like 18. Okay, what's that? Like 1830, 1840 just not so long ago. I mean, just a little while ago, we were almost at 20, and now we are kind of knocking on the door to 17. Um, we have definitely established a strengthening trend at the moment. It does look like, I mean, the bottom of that channel, I think we might see the 16 handle again. The one thing that's kind of like the kind of lows in October 2024, is that October 2024? Like these lows that you're looking at over here, we're kind of approaching those lows, and that often forms a horizontal support on the on movement. So it easily could bounce off that. We are also towards the bottom of the channel, so I would say this is kind of a moment where I think you're going to find some real resistance around 17. I do think that you might see it just pop below 17 as well. But yeah, for now, I would probably be saying, like I said, when I remember we did a presentation up here, I said, guys, you got to bring back currency. Like we're right at the top. It's formed this beautiful thing. It was a good call at that stage. Here, I think we're getting to the stage now where you can quite safely, we've got what, 2 months, 3 months left of the year. 2 and a bit months left of the year. Your SDAs are going to expire, so that's the single discretionary allowances. If you haven't used them, it's a pretty good level. I'd probably take out. The other thing is I always like pull up. So this is the LSEG polls, 1st of October. So this is the most recent poll, and I always like to look at the minimum max estimates 1 year out. That's kind of like where I kind of feel like it works quite well. You look at the minimum estimate from kind of the people in the know, look at the maximum estimate. Minimum estimate's around 1650, and Goldman Sachs has been bearish on I don't know if they've been bearish on dollars, but they've been bullish on rand. So I suppose bearish on dollar ZAR pair for a long time. I mean, they've always kind of come out as kind of the lowest estimate, and we're approaching that. We've got BOFA there as well, 1650, and the rest kind of hovering in the 17. So I still don't think it's like the best. I mean, this is not like a spike stronger that you're getting this amazing level. But if I had to choose which way around to go, I would go long dollars, short rand at the moment. But it's kind of tentative. It's like a 40-60 feeling. Because we still got DZ Bank, Capital Economics, Citigroup. I mean, there's still a couple above 18, but that range is starting to narrow as well. Your mean estimate around 1734. So again, not too much in the currency. It is quite an efficient market, and unless we see real challenges in South Africa, let's say we see load shedding come back, for example, you'll see this thing move dramatically. And I mean, we kind of always discuss it. I mean, we had another long discussion about it this morning in research. Um, yeah, there are still, everyone is very optimistic about South Africa at the moment, but there are still real fundamental challenges in South Africa. That said, if there were no fundamental challenges in South Africa, we'd probably be at like 14 or 13. So yeah, I think kind of fairly priced at the moment, but with a slight tendency to moving currency, moving currency out at the moment. That said, longer term, I do think the dollar is going to depreciate. When I say longer term, certainly while Trump is in power, I think the dollar is going to continue to depreciate. So it's kind of move it and then invest it. You need to use it to buy something. But what do you buy? Because at the moment we're kind of sitting in like this really weird position where we've got markets at record highs. Like, I mean, and you can see the recovery. That was the Liberation Day sell-off that we saw earlier in the year. Absolute panic, 20% down. Pinged the estimate that Viv and I made at the beginning of the year, saying that we do think it'll be 20% down, but we do think the market will finish higher for the year. Looks like that was a great prediction. So big sell-off, pinged that kind of just over 20% down on the S&P 500, now rocketing higher. And I look at that and I'm getting nervous. I'm getting really nervous. So I kind of maybe agree with the one headline up there where the guy says maybe it's a nice time to buy puts, and maybe it is, because at the same time we've seen volatility starting to elevate. So the blue line here is the volatility index. You've seen vol pick up a little bit. Remember, we were kind of like perennially down in like the 12 and a halves. We're kind of 16.5 at the moment. So vol is a little bit elevated, but nothing like what you get when there's a real like nerves and panic. Yeah, I mean, this was 20. I mean, look at like the range on volatility, in 2022. So we kind of low at the moment. Look at the spike that we got on the Liberation Day tariffs as well. So this is basically saying that if you were to buy insurance for a portfolio, if you are going to use like an option structure, the options will be probably quite cheap at the moment because volatility is one of the inputs to option pricing. Um, so yeah, it's not to say that things are going to fall apart. Volatility can stay low for a long time. Markets can go up for a long time, but we're again. This is kind of saying that we're in a more, for me, a more sanguine part of the market. There's almost a complacency among investors at the moment. That's what the volatility index is telling me, and you kind of see it in the stock prices as well. Like I mean, at least in the index level. But the index is not telling the whole story. And that's why I want to kind of have a look at this. Okay, so let's have a look at this one thing. And again, it comes down to like a very narrow rally. So I'm going to look into the index in a little bit, but this is kind of where we are year to date, constant currency comparison. So let's take all the markets around the world and go and rebase them into US dollars, make sure it's a total return. So this includes dividends and all that. You can see the S&P has actually had a pretty torrid time of it this year. I mean, it's, for the holding period, this is a year-to-date performance, up around 15%. And when I say torrid time, you consider that in dollar terms, the South African market is up 53% for the year-to-date. I mean, that is absolutely astounding. I mean, that is really, really strong. I mean, like unbelievably strong. But I mean, fantastic. And again, it comes down to buy stuff on kind of lower PEs, or does it? We're going to look at that in a second. But this is kind of the spread. The S&P hasn't done well. NASDAQ is doing slightly better. Again, obviously more exposed to that AI rally. We've seen a big re-rating in Europe in dollar terms. We've also seen Hang Seng. We've seen a big pickup in China as well. I mean, we've got Alibaba in the portfolio, obviously. I think Alibaba has done, I mean, it's over 100% of I think, year to date. I mean, I think we've done like almost 60% in the last 3 months on Alibaba. So China is picking up in a big way. MSCI World, obviously, and I'll show you something in the MSCI World now, that's largely dominated by the US. So that's why the MSCI World has underperformed in this period. And I'm just looking at year to date. China up 36%. Even the FTSE, with all the problems that we have in the UK, we've seen the FTSE outperforming as well. And a lot of this is, I believe, due to the dollar weakness and the fear around what's going on in the US at the moment. Shut down governments, erratic policy. You are starting to see, some punishment of the US around kind of like the things that have been happening this year. But if we take gold now and we take it, instead of rebasing this to constant currency in gold is up almost 55% in US dollar terms for the year, which is why I keep getting asked about gold and why we keep doing gold shows and all sorts of things. But if we think of gold as a currency instead of a commodity, if everything was priced in gold pieces, every market is down for the year. So gold has been the best performing asset class for this year. I mean, just what it is. And that also, again, it's kind of a little, when I say a little bit of a flag, it means that there's a lot of fear out there. There's a lot of people looking for an alternative hedge. There's a lot of people out there that are going, ooh, I'm getting nervous of this rally. And that's just what it's saying. So how narrow is the rally and how much has this gold price actually influenced the South African market, which has done, like I said, I mean, in dollar terms, our market is up massively, massive. So this is where the returns have come from in our market, unfortunately. So, 9 out of the top 10 performers are gold and platinum companies. So it's not just gold rallying, platinum has also had a massive rally. So these are also year-to-date returns. And you can see out of the top 10 stocks, 9 of them are gold and platinum counters. And you can see the level to which these have rallied as well. I mean, Sibanye-Stillwater, which was in our local portfolio, I have recently exited it. If you're looking for indications on what we're doing, which I suppose is the point of this, we have recently exited Sibanye. And it's not to say that I don't think Sibanye can run a lot harder. Sibanye was up at 70. This is maybe not a great exit, but a 250% run, in kind of 9 months. We're happy to take a little bit of profit at this stage. looking at, I understand the argument that the ASICs are very low, understand that these companies are printing money, they are printing money. There's no indication that gold miners are going out and doing stupid deals at this stage, which does kind of tell you it's early cycle. But after the kind of rally that we have, kind of like on our pricing models at $4,000 an ounce, even with the kind of high operating leverage these companies now have, and even that the margins have absolutely exploded and they looking great, the contrarian hat is on. And I'm saying, like, if gold price doesn't rally if it goes to 5, 6, 7,000, if it goes to Adrian Savil's target, it's not his target, but like if it goes to $101,000 an ounce, these are going to go absolutely berserk. These are the biggest companies in the world. But if the gold price starts to hover here, if we start to see, kind of changes in central bank policy, if we start to see a slowdown in buying, if things change, I do think that these are more than fully valued. So I'm literally just trading off where the price is now. I'm not making a prediction on the gold price. I'm saying that based on where the gold price is today, the stock is probably a little bit too expensive, and that's why we've sold out of Sibanye. But it was like last week that we sold it. Wasn't this week, it was last week. So it wasn't like I'm sold it a long time ago, but yeah, just getting a little bit cautious there. You look at the rest of them. I mean, Anglo Gold, DRD, Northam, Goldfields, all of these platinum companies, even African Rainbow Minerals. I mean, a lot of ARI's revenues generated by platinum as well. If you drop these 10 stocks from the index, you lose about half the. So I mean, this index is, I've done this. This is the index I'm talking about here is actually the all share index. So it's not just the narrow top 40, because obviously the all share index includes all of these. You drop 10 stocks from the all share index, you lose about half of that performance. It was heavily driven. Obviously, you've also got the likes of Prosus and Naspers up there. I mean, these are stellar gains from Prosus and Naspers. That's as China recovers. Whoops. Oh, where did I go? So that's as China recovers. So Naspers and Tencent absolutely like shooting the lights out. Chinese recovery, that's also forced it up. That is such a big component in our index. You take those two out as well, you basically almost a flat on the index. So if you're looking, so just to kind of put it in context as well, it's narrow. It's a narrow rally, very narrow rally, like very specific, one sector. And that's why, like, if you are looking at, your own personal stockbroking account, for example, I mean, we've done pretty well, but we've had some gold miners. But if you're looking at it and you go, oh, well, I haven't really done as well as the index, I wouldn't beat yourself up about it. You have to be pretty crazy and pretty concentrated. You had to kind of take like a massive gold position to really do it. And if you didn't, yeah, the returns maybe aren't as impressive as you thought. And now just like kind of following that narrow rally theme onwards and looking at something, I just want to show you something that I was reading a report the other day. I found it quite interesting, and it's something that I've talked about a lot around like index investing and kind of trying to understand what is inside your product rather than just going, oh, everyone says this is going to work. I watched an Instagram video and they said you should always buy an index. And then you don't think about it. You don't think about it carefully, and you don't interrogate, and you don't understand what you're actually doing inside that. This is something that like was picked up in a research report, which is quite interesting. So this is a chart comparing. The blue line is the S&P 500, and the white line is the S&P 500 equally weighted. So the S&P 500 is a market cap weighted index, which means that the bigger the company has, the more impact that it has on the index. And you can see what's happened is these have generally performed kind of in line. Like there hasn't been a big discrepancy between the S&P 500 and the equally weighted. So it's kind of been a broad positive US theme. US businesses have all been doing well. Great. The US economy is performing well. It's very broad based. What's happened, and specifically since 2023, you've seen these jaws kind of start to open. And that's because you've seen a huge concentration in the largest stocks in the index. The ones that have the most impact have also been the best performers. And what it's done is it's left the equally weighted index behind, which means that of the S&P 500, if you like kind of the big guys, if you invested in those big guys, you did great. But if you weren't invested in those big guys, the rest of the index has actually been pretty average, pretty mediocre. I've just done a relative for you here. So this basically divides the one price by the other price. So well, and we made a percentage, but this is a relative of like how it underperforms and overperforms over time. And you can see here I mean, I've gone all the way back to when the index started. You can see kind of stable, stable, stable. And you actually had a long period where the equally weighted index outperformed the market cap weighted index, saying that this is a broad recovery in markets. It's the whole economy participating. It's many businesses, achieving profitability and stock prices being marked up. Obviously, we had COVID, things went a bit crazy all over the place. Businesses were shut down, earnings were all over the place. The whole market was in a lot of turbulence. So you saw a lot of, it's up, down, up, down. But what you've seen now is kind of like since these two indices began, and when I'm saying the equally weight index, or at least when I have data anyway, all the way back to kind of, okay, it's just over 20 years. This is the most concentrated the S&P 500 has been in a long, ever, basically, ever. So you've had this huge concentration in the S&P 500, and that's been picking up dramatically. And if you look at it, you can kind of understand why. So this is the 20 largest companies in the S&P 500. The 10 largest companies now make up 40% of the index. So if you take NVIDIA, Microsoft, Apple, Alphabet, FANG stocks, Amazon, Meta, Broadcom, Tesla, Berkshire Hathaway, and JP Morgan, those 10 stocks, and you invest in a diversified ETF that you've been sold to by your friendly neighborhood financial advisor or the blog article that you've been reading, and you've said, oh, but you get access to the 500 biggest companies in America, and America is a great capitalist economy that rewards shareholders, and it's the best place to invest. Don't worry about your wealth. Put everything in the S&P. And you know how many times we hear this from clients? Put everything in the S&P 500 and just leave it. You would have done the best performance. You would have. It's true, especially when it's running like it is now, and it's a point performance. When it falls apart, I mean, you think about like the NASDAQ after .com, decades before you get recovery. So again, just a word of caution around kind of like not understanding the product, number one, but two, understanding that if you're putting a massive portion of your wealth into like an S&P 500 index today, it's a very different prospect than it was a little while ago. Because it's not just that, these are also like quite correlated companies as well. So JP Morgan Chase different. I mean, that's financials, banking, etc. But these FANG stocks are the big tech AI plays. If AI falters, if it gets to a stage where we don't get AGI that can justify the spend that is being made currently, it's going to fall heavy and you're going to suffer. So it's a warning. The top 20 make up 50% of the index. So if you buy the S&P 500, half the cash that you've put in the S&P 500 is 20 companies. 40% of your cash is 10. So just be careful is all I'm saying. So then you think, but don't worry, I'm running a diversified ETF strategy. What are we going to do there? We're going to go buy the MSCI World as well. So I've got a little chart of the MSCI World over here. MSCI World is 72% US at the moment. MSCI World is almost as bad as the S&P 500 if you're looking at the MSCI World Index. This is not, I've got a diversified portfolio that is exposed to the whole world and its future. You have got a 72% of your money invested in the US as well. So just understand what you're investing in. And I'm not saying it's bad. Like I said, like the bolded companies in this at the moment are companies that I hold in the global equity portfolio. We have NVIDIA, which is up 40% year to date. We have Microsoft, 25. We have Alphabet, which is 30% up. We have JP Morgan. We have Visa up 11. We have Johnson & Johnson up 34. We have these companies in our portfolio. And I'm not saying they're not good companies, but I'm just saying when you're looking at the overall portfolio construction, you've got to think about that. You've got to think about what you're investing in. And then also, this is just, so also like, I think one of the big mistakes that investors make when they look at, they're kind of trying to compare things, is they go and look at the last date and then they look backwards and they go, over 1 year, 2 year, 5 year, 10 year. That obviously is taking into account like the point that we are at in the market at today. So this is the same thing. So this is just a relative. Oh, okay, so I've just used a 10-year period, but I'm taking it basically from when the two indices began. And I'm taking it to 2014, a very different point, so that we're not kind of like skewing data or anything like that. And you can see what happened last time is you were kind of running flat. You had this big spike up in this index started to become quite concentrated. That was literally November 2008. Then we had GFC. I'm not saying anything, and then equally weighted, way outperformed the more concentrated ones. So just saying, looking at these big tech stocks, they're running well, but I think a word of caution as well. And yeah, like I said, that's kind of like 2008, and the white line is now the equally weighted one. You can see the outperformance that the equally weighted one had following the GFC. So just some food for thought. Sorry, I'm being a scaremonger today. I didn't mean to be. But um, does this mean you should sell all your equities? No. Interest rates are coming down. Things are going to be okay. What you should do is you should have a well-diversified portfolio across many asset classes. You should have gold. You should have properties. You should have all sorts of different exposures, but that really depends on your own personal outlook. Remember, in the short term, cash is very, very safe, but in the long term, cash is very, very risky because especially if inflation is starting to pick up as well and the Fed is not cutting and that's in the offshore market, locally, I think the cash is maybe a little bit safer because we've got that big real yield. I'd probably be more favorable to be sitting on South African cash. But long term, if you're a serious investor, you should be in investment products. You shouldn't be sitting in cash. Cash is a short-term parking spot. And switching things to say, okay, let's just get out of all the equities. This needs to be tailored to your own risk profile, to your own objectives. So I would highly recommend speak to one of our wealth managers before you just go, oh, I'm going to pull all of my money out of equities. Because what do they say? Markets can remain irrational longer than you can solve it. And jumping in and out generally means that you lose more. And it's more about trying to position yourself correctly to weather the storm rather than just saying, I'm going to dive off the boat. Okay, so let's have a look at the portfolio. So let's look at the portfolio overview. Okay, so first of all, global equity portfolio, we benchmark against MSCI World, which I almost think is time to change. We've done better than the MSCI World, but like I said, it's starting to feel almost like it's become so concentrated now, like it's not actually achieving what the objective was with that the portfolio was designed to do. And I thought like this is actually quite a nice time to just like review what is the global equity portfolio and why and what is our thinking behind it and how do I invest. So we have a very racy AI portfolio, which is all of the stocks that we've been talking about. If you believe AI is real, I'm an investor in it. I've got my own cash in. Bev has done an amazing job. He's 2 years into that portfolio and he's just hit 100% return. It has been a spectacular ride, a spectacular ride. I'm terrified and I definitely don't have all my wealth in it, but I'm loving being part of it. And I really recommend you go watch Viv's AI updates. And I think he's doing a presentation on the AI portfolio next week. It's very compelling, and it's a theme that we love at Rand Swiss. So while I'm being quite pessimistic, we do love AI at Rand Swiss. It's one of the reasons that I was part of the decision-making team to say, let's launch an AI portfolio. It wasn't like snuck into Rand Swiss. Like we like the theme. We wanted extra concentration because we like it that much. But understand where it is positioned. And if we go back to that efficient frontier, it's a far more risky portfolio than the global equity portfolio. The mandate that I was given on the global equity portfolio 9 years ago was this is people's offshore nest egg. That is, when you're sitting in South Africa and you're the typical client, you should be maxing your TFSA first. Then you should be maxing your RA contributions, which are constrained by Reg 28. Then you should probably have a paid off house. You should probably have, you've probably got cars and all sorts of other assets locally, and you probably have a job in South Africa. That's a huge concentration of wealth that is already stuck in South Africa. So the next step to that wealth was saying, we want an offshore nest egg. We go and do this through direct stock portfolios. We have Swiss banking partnerships. We open a Swiss bank account for you overseas, and we go buy direct equity in the Swiss quote account with a long-term time horizon. in literally the most efficient way possible, but trying to do it understanding that this is a nest egg portfolio that we have to do risk budgeting for as well. We're trying to do it at a lower risk as well. We want to try and beat the market, but we're not here to try and shoot the lights out and swing for the fences and go and put 70, 80% of your portfolio into Bitcoin. We're not MicroStrategy. That's not what we're doing. We're not trying to generate the highest performance possible. We're trying to generate the safest performance that will beat inflation and grow your wealth longer term. And typically these kinds of deposits are people that, they're working. There's no call on the cash in the short term. That's why it's an equity portfolio. But you park it in your offshore account, you forget about it, you let it grow, and it kind of almost acts as your go bag, your safety bag. If everything goes bad and you need to quickly go overseas, you're not a refugee, you're an immigrant because you've got cash. You've got an offshore bank account with kind of like very stable, very blue chip stocks in it. That's what we built. We could have done it through a fund structure. We decided rather to do direct stock portfolios. For us, it lowers cost. There's no management company fees. It's an incredibly efficient structure. It's also an incredibly transparent structure because you can log in at any time, see exactly what holdings are in your portfolio. You can go and audit how we traded your portfolio. You can see when we bought, when we sold. You can go and see like if there's excessive churning. You can go and see, which you can't tell inside a fund. You can go and have a look at exactly what the weighting of the stock is in your portfolio as well. So it keeps us very honest. Like you can't suddenly have a big position and then hide something. It's all there in your statement when you go and have a look at it. So we like the transparency, we like the efficiency of the structure, and we like because it performs a specific function. That's what this portfolio does. It's not designed to, but at the same time, we saw AI as a theme. We liked it, so we launched an AI portfolio. And there's plenty of new products coming as well, which I'm particularly interested in our private equity one. We've also got a nice hedge portfolio, I think, that's going to be coming soon, which I'm excited for. But each of these themes need to be put in your own personal context. For me, blue chip equity, we've been through many crises and many crashes. Never once have I worried about one of my stocks or one of the businesses that we invest in going bankrupt, because it's just not, this is not speculative stuff that we're doing. If you have a look at it, like what I've been doing in the portfolio recently is that we have been blending far more towards value. As much as interest rates are probably going to be cut in the next little bit, I look at some of these, the PEs on the stock, and I do take a far more value approach to this. I need to understand what the business does. I can't go and buy Palantir when I have to just believe that they have defense contracts. It needs to be the type of business that I can understand properly. And it has to be slightly less speculative in nature. Than what you would usually expect. So you can see our value, if you look at the style box on the top right here, value is 48. I've only got 11% in growth stocks. This is not a growth portfolio. It is a value portfolio. You can see it also, like, I mean, we well diversified at the same time as its value. It's not like we're shying away from AI either. We've got a 20% weighting in information technology. We've got quite a large weighting in financial stocks. Healthcare is also an important component to it. These are kind of like the sectors that we really like at the moment. Consumer discretionary we've brought down a little bit recently. Like I think consumer discretionary maybe a little bit of a bit of real estate, but energy. It's meant to be a diversified portfolio that will grow over time. As you can see, like in terms of risk, our risk is slightly lower. Our return is slightly higher than MSCI World since inception. We have a long track record. I mean, we're going all the way back to 2016. And you can see, I just want to like kind of highlight this beta here for you as well. In terms of beta is how much you expect this portfolio to move compared to the underlying index. So we've got a beta of 0.85, which means that we should fall. If the index falls, we fall much less than the index. When the index rises, we're not probably going to rise as quickly as the index. That said, it's not like we're shying away from stuff. I also have, as part of the structure of the portfolio, I have specific limits put on me in terms of the size. We have to re-weight down when there's concentration risk, because we know a lot of people have given us a lump sum of money that they don't want it to have a 20-30% exposure to a single company that we just really like. So there's mechanistic positions in here to keep the portfolio manager from making almost riskier decisions. It forces us to be a little bit more conservative. So at 10%, we downweight a stock. It's like, even if it's running, we have to downweight it because we don't want a new investor, or we don't want existing investors suddenly to run the risk that one stock that was shooting the lights out drops 90% because something goes dramatically wrong with the business. That you're protected. We're almost forced to take profit and reallocate the funds to new investment ideas as well. We are kind of running quite hot on, like I said, Alphabet was my stock pick last quarter. Alphabet running kind of hot at 6%. But yeah, like I said, JP Morgan, BlackRock, asset manager and a bank, even within the financial sector, we've got banks, we've got asset managers, we've got a payment system in Visa. Like it's very diversified. Like even at the subsector level, we try and diversify away risk. We're not trying to concentrate risk. If we are trying to concentrate, what I say, concentrate to create, diversify to protect. This is more, it's still an equity portfolio, but it's definitely got a protection bias towards it. Yeah, so sector tilts at the moment. Yeah, so I'm not going to run, sorry, I'm going way over, so I'm going to kind of hurry up for a little bit for you. Sector tilts at the moment. I don't think there's too many changes in our sector tilts currently. Still kind of quite optimistic on healthcare, still like financials. I've still got information technology. Like I said, like we're not negative on it yet, but I'm not as positive as I was previously. Certainly not 2 years ago. Communication services were a little bit underweight at the moment. But yeah, I always look at these tactical and strategics. And for me, like this is very much a top-down approach. And we do look at the top-down quite, I mean, we like the macro stuff, as you can see from most of the presentation. But fundamentally, when we pick stocks, it's a bottom-up process. And I kind of always look at this and go, yeah, but if it's a great energy company, like who cares what the sector weighting is if the company's that good? We want the tailwind from the sector, but we're trying to select the best stocks. Then just in terms of moves on the portfolio recently, we had a position in Pfizer. We have exited Pfizer now totally. One of the mechanisms that also sits in the portfolio. When we purchase a stock, if it falls below 2% in the portfolio for whatever reason, stock price comes down, well, that's generally the reason, spins off a whole lot, whatever, and it becomes, like let's say there's an unbundling or something like that, and the remaining amount is too small. It immediately triggers a review on the company. We've got to go back and really reassess the position, and we're forced to either make a decision to top up or exit. That is now happening. It's kind of something new that we've brought into the portfolio management. Yeah, and Pfizer was below the 2% level. We're forced to relook at it. And Pfizer is just not the company that it used to be. So we actually bought this company in September 2016. It was one of the first companies that we bought, and it actually, over many periods, has done very well. Specifically over COVID, when we had the Pfizer vaccine and it was running hard, it really was one of the blue chip entry points to the US drug. As a US drug, it was a core US drug company. I mean, they had a strong patent pipeline. They, like blockbuster drugs were available, and it was a very core business. It was looking like the best pick in the world after COVID, but since then the business has changed significantly, and they're going through an aggressive cost cutting at the moment, and specifically that cost cutting is happening in the R&D as well. And for me, that hurts long-term prospects. And one of the things that you need in any business that you're buying is you need to have the view. Like it's kind of a value approach that I take. It's the kind of Buffett. I want to be able to buy this. I want to be happy to kind of buy this and own it forever. If they shut the stock market tomorrow, I want to be happy with all the shares that I own. That's kind of the view on the portfolio. But it has to have innovation. And if they're cutting down on R&D spend, I don't like that. There's also increasing competition, specifically around Prenvar from Merck and Ibrance from Novartis. So yeah, it's a much more competitive environment at the moment, and Pfizer hasn't been covering themselves with glory. And also, like, sales have normalized over COVID. I'll be the first to admit I never expected the sales to pull back as fast as they did. The speed at which they rolled the vaccine out, and even though COVID came to an end, like the technology that was within Pfizer should have kind of maintained profitability. And I thought that the market was looking through it. I was wrong. I really thought that the stock was being priced at a level, given that there was going to obviously be a drop off in COVID sales. But somehow the market was surprised that COVID ended, which is weird. And to me, still weird. And obviously, like, I mean, the stock price has been marked down materially, even in earnings terms. I mean, it only trades on a 13 PE now. We actually bought it on a much higher PE, which was, in hindsight, a little bit of a mistake. Because I've held it for so long, I mean, we actually did make a profit on it anyway, but it has been detracting from the portfolio. So we've cut it out and we've exited it. One of the other concerns I have just around the direct pharmaceutical exposure is that the regulation around pharmaceutical companies is just so heavy. They make supernormal profits. They get taxed heavily, like they get told to cut drug prices, specifically if it's, the kind of, I mean, if you're talking about oncology medication and that, it's a very politicized, segment of the market to play in. So what we've done instead is we've gone into, so Danaher was a smaller position in the portfolio. I actually took a small position in it originally. It wasn't a full position. But I've had a relook at Danaher properly. Like, this is something that I do like. It literally, so we run a quant ranking model in which we select stocks. So Google, okay, like I said, Google is still ranking top. It's right up there, that's why it was my stock pick in the last presentation. Google is right up there. It's literally ranked Google, Danaher, Microsoft. Like, that's where the ranking is sitting on our quant model. So I like just from that was enough to go and have a look at it properly and say, like, this is something that is pretty interesting at the moment. It doesn't seem obvious. And again, we're buying in on a 43 PE, which, I mean, again, not a great value manager, but if we go back and you go and read here, I said valuation plays an important role in our investment process. Here it is. Valuation plays an important role in our investment process, but premium rated stocks will be included when there are expectations of supernormal growth. So Danaher is on a 43. Like, we are expecting a big pickup in earnings in the next reporting, and we expect the FPE. So the FPE should be around 27 just with the earnings pickup. Which is going to make it a lot more reasonably priced. It looks bad now, but like, those earnings are coming. Why are those earnings coming? There's been Danaher does buy and sell a lot of companies. It's quite acquisitive, and they have been rejigging the portfolio at the moment. And with that, there is an opportunity to cut a lot of cost out of the business. They're far more focused on healthcare now. But just so that you understand what Danaher does, Danaher is, I mean, they've got three segments, which is biotechnology, life sciences, and diagnostics. But they make essentially like equipment that is used in labs and physicians' offices. And it's almost, you can think about it as the pick and shovel provider to the healthcare sector. It's kind of almost a pure play on healthcare innovation. It's like the NVIDIA to OpenAI. Like, it's the guys that give what needs to develop new exciting research technologies. So that's where it is positioned in the supply chain. The other rationale is, like, there are secular tailwinds to healthcare and biotech. The problem is trying to extract the value from that segment of the market. So we have aging populations globally. Like, there's no question, demographics are destiny. Healthcare is going to be a big player in the future. At the same time, like, new diseases coming all the time, and precision medicine is accelerating. There's no question about it. This is a growth. When I say a growth sector, it is an exciting sector that I also think will pick up dramatically with the kind of development that we're seeing in the AI space. This will be one of the beneficiaries of it as well, in that you are going to be able to develop drugs quicker. You are going to be able to all of these things, and all of that will feed into, like, a company that is spending on R&D and has the ability to remain innovative, which Danaher, I think, far more than Pfizer has. It also positions it in, it's a non-discretionary spending company. Like, this is not a fad type stock. It's not something, like, you probably have never heard of Danaher before. But it's also it's counter-cyclical. The spending for Danaher, and it's got a long track record, is even in downturns, even in economic times of economic stress, Danaher's earnings are generally pretty stable because of the type of clients that it services. When you're servicing for physicians' offices and labs, like, people are not shutting that down. This is kind of the kind of research that continues. What are the risks around it? Okay, so there's always the execution risk. I mean, like I said, they've tweaked their portfolio a little bit. So if they in kind of creating the additional profitability that I'm looking for, if that doesn't come through, that's going to be a risk to the stock price. How material is that risk? If Danaher is like, this is what Danaher does. It's actually, yeah, it's what they kind of do. It's their job. So they've got a long track record of doing it, and they've done it incredibly well. It's all built on what's called the Danaher business system. But anyway, so what's the other thing is, like, they could potentially do new acquisitions because, like I said, it's quite an acquisitive company. They could do new acquisitions at the wrong prices. Again, the track record says they don't do that, and you do to an extent trust management that they will do it correctly. And then, of course, there's increased competition in the sector. But remember, like, the kind of stocks that we're buying in this portfolio. This is a 146 billion market cap company. It has a significant economy of scale. There's a wide moat around this business. You can't go and make the machines and do the research and build the instruments that Danaher builds as a startup. You need massive funding to do it. So they do have a very unique position in the market, which also adds security to it. But yes, competition could potentially increase, but also they're pretty good. So yeah, that's kind of my pick and shovel provider. That's kind of what going to be my stock pick for today. Then just a review of the last 3 months in terms of what's in the portfolio and what we've done. Remember, AMD is a newer acquisition. Obviously, we got the announcement 2 days ago. I mean, we've had like a 70% rally basically in AMD over 3 months in the last week. So that's kind of topping the table in terms of, like I said, we're not exposed to tech. It's just we're doing it in a safe and secure way. Alibaba also, like I said, I mean, 67% up in the last 3 months. China is having a massive, massive rally at the moment. Alphabet, probably my favorite stock in the market. Johnson & Johnson also up there. United Health. Remember, United Health was one of the upweighted positions from last time. We actually bought it just before Warren Buffett, Berkshire Hathaway announced that they were buying into United Health as well, which is always great because I think the easiest way to, if you not following a managed portfolio, the easiest way, I saw a video, I don't know if it's true, I've back tested it. So they said, but if you waited for publicly available information to be, if you waited for the information to be publicly available on what Warren Buffett had bought, then you waited till the end of that month, went to the worst broker in the market with the highest fees and bought it, you've still outperformed like most asset managers in the world. So I'm very happy. It's a great investor. Hopefully, like, the new team is as good as he was. But yeah, on the downside, Disney a little bit disappointing. That's kind of coming off that 120 level. The two kind of, I suppose, tech exposed, Salesforce and Adobe, are actually AI stocks as well. They've been perennially disappointed. And Chipotle has come down heavily, but like that, again, like, I mean, we had a huge run up on the initial purchase. We're coming back to kind of entry. And obviously, SLB is our energy play. SLB used to be Schlumberger. Oil prices are low, energy markets are low, so it's kind of responding to that. Energy pricing is cheaper. So yeah, stocks are volatile, but when you put them in a portfolio, the volatility decreases significantly. So that's the winners and losers. And then asset class tilts I'm going to skip. And then, I think I'm out of time, so I'm over hours. So we are doing our October structured product tomorrow. So at 2 o'clock tomorrow, we're going to be we're all going to be jumping on a call. Viv and I will jump on a call. We're just going to take you through our October structured product. It's pretty much our standard. This is actually a roll product. So last year we had we had a whole lot of guys, got like a whole book of people that went into it. Obviously, the markets are now positive. They've gone up and everything's good. A year later, they're getting their coupon, and now we're reinvesting so that we can compound the coupon. So we can open the structure again to new investors. Minimum duration 15 years, capital protection 30%, annual coupon we're marketing at 12. We'll see. Volatility is quite low and interest rate expectations have dropped as like the expectation is that interest rates drop, as we were talking about. So the coupon that you're getting might not be the 14% that remember, we always market at kind of 12. Last year we market at 12, we give you 14. I'm just saying we're marketing at 12 as normal, but it's probably going to be like 12.1, 12.2 is kind of where we're pricing at the moment. We're going to strike on the 22nd of October. We'll see if markets crash, if volatility changes, if things change like they did. I mean, we got a 15% coupon when Liberation Day happened on that note, which now looks absolutely spectacular, which everyone who invested in that note is going to be very happy, I think, in April next year. But yeah, so kind of 12% coupon. We'll see where it goes. The usual 9 chances to win. This is fully offshore, US dollars, 20,000 Rand minimum, $20,000 minimum deposit into the note. Yeah, it can be held at any of the custodians, A-rated investment grade bank, blah, 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 blah. So we're going to do a webinar on that tomorrow. So if you're interested, and I've got some cool slides, not these ones. I've got some cool ones to show you, just like kind of when these structures and why it, you might have, like I said, we build these products specifically to kind of cater to certain needs, because we don't know what the aggregate person needs. So we kind of like when we engage with them and our wealth managers come to us and they kind of ask us what they require, that's what we're building. So like I said, TFSA first, RA next, your house paid off, then you go offshore because your job's in South Africa. That's where your global equity portfolio. But like there are certain cases like now, like if you can't have everything in that, you diversify into other products as well. And each one kind of has a place depending on what you're trying to achieve and depending on age and all the different risk metrics and all of that. But very cool product. Going to show it to you tomorrow. If you're interested, join up. Otherwise, we'll stick it up on YouTube as usual. Thank you, everyone, for listening to me. And yeah, any questions? I think I've got a whole lot of questions. Okay, look, great show. Thank you. Thanks. That's great. Should I buy US ETFs in my US trading account or buy local ETFs and hold them until the dollar strengthens? So that's a great question. So, okay, so that's a great question. So our view, and I mean, I know, like I say, this is a contentious view. Like it's kind of been debated by some other people in the industry, but we've had like attorneys and everyone look at this, and yeah, I'm pretty certain. I'm like pretty certain of it. But anyway, what do you want to do if you have a US if you have an offshore US trading account or an offshore account? I would say go and buy your ETFs in your offshore account. Why are you buying them in offshore account? If you go, like I look at I should have put a slide on our local ETF, offshore. We've got an offshore ETF model and a local ETF model. The local one sits in the tax-free savings accounts because we can't go offshore with tax-free savings accounts. The offshore one sits for diversification within offshore portfolios, you know, for whatever reason. But like I said, we'll need to do a wealth meeting with you. But the offshore portfolio, the costs of those asset management products are significantly lower. You're talking about like 2-3 basis points for those instruments. So the costs are much lower. And at the same time, if you are a South African tax resident and the currency is depreciating, you don't pay tax on the depreciation of your principal on a direct offshore account so long as you don't bring the dollars back. If this is your nest egg that you're leaving offshore, then you're not going to pay tax on the depreciation of the principal investment. But if you put R1 million into an S&P 500 tracker like the SIG US, like Signia's version of it, you put R1 million in there and the currency goes from 17 to 34, you pay capital gains tax on the depreciation of that R1 million, which you avoid if you invest directly offshore. So for me, the simple thing is, and specifically if you're looking for diversification, I mean, I own properties in South Africa. I have a business in South Africa. I've got RAs that I've maxed in South Africa. It's like all South African. Offshore, keep it offshore. Local, different story. If it's in a business, so that's where that's where it's a little bit different. Like, so if you're trading through, like if you are building up in a local trust or a local company, it's generally there, like we'll do an assessment for you depending on which ETF you want to buy. But if we have to create an asset swap for you to go overseas, you're going to have an asset swap fee tacked onto that. That might not be worth the difference between buying a feeder ETF locally as well. So again, it depends on you. It depends on your structure. But yeah, if it's a local trust that we're investing for, a local company, it can potentially be better for the local ETFs instead. What's the alternative to tech stocks? Anything that's not tech stocks. kidding. I love tech stocks. Like I'm invested with them. I'm invested in that portfolio. I have 20% of this portfolio, like heavily, like when I say 20% of this portfolio is exposed to like, yeah, tech stocks as well. Tech is great. Like, let's not get, don't misunderstand me there. I do like tech. I do like the AI theme. Remember, we did launch a product specifically to capture extra of that theme. But what alternatives? I mean, all the other sectors. Which alternatives would I look at? Yeah, I mean, we were chatting about that research about 3 days ago. I like the look, like if you're looking specifically, like I like the look of the financial sector at the moment. You'll also see we're quite highly weighted in the financial sector, but it also comes down to like, I mean, from a stock picking point of view, at the moment, healthcare, Danaher. There we go. Question answered. Okay. I missed part of the recent small and mid cap. When will it be published on YouTube? I'm so sorry. Like that's taken a day or two. Like I said, we're bringing in new resources. So I think we've got 5 new people starting now, or 5. We've got 3 more starting. So we're building capacity, and hopefully we can get those out quicker. But I think if it's not up already, which I think it might have gone up today, it will definitely be up tomorrow. If you've registered for a webinar, as usual, we will distribute the links to you. So this one actually it doesn't get published. It's just for the investors that register, and we distribute it. So we do some content that we hold back from kind of the public. This is one of them. Anthony's isn't. Anthony should just be on the YouTube channel when you go and check it out. Ian, well done. Thanks, Ian. We need to have a chat, actually. Vanna, what is your view on silver ETNs? Silver's a weird one, man. Like, it's a really weird one. So, yeah, silver, I mean, if you look at the gold silver ratio, I mean, everyone's been saying silver is the way to play it. I'd much rather play it through an ETN than physical silver, I'll tell you that. Like, it's not as durable as gold, number one. But two, it's so big. Like, it's just so big. I think you buy monster boxes. I was sitting there chatting to a client about it a little while ago. He said, "Oh, you buy the monster boxes." I was like, "Yeah, but it's like if you want a proper exposure to silver, like when I say like an investment exposure to silver, I mean, you're gonna have to have a room dedicated to it. It's like a lot of silver. Silver is not like priced the same as gold. So yeah, ETNs are a great way to access it. Just remember, like an ETN versus like an ETF. Remember the ETN, you carry the counterparty risk. Whereas with an ETF, you have a claim on the underlying. So like the new gold ETF, for example, you actually have a claim on physical gold. I think they store it at the Rand refinery. With an ETN, you're taking a promise from the financial institution that you're buying it from. And there's nothing wrong with that. Like, I mean, as long as you trust the bank that's writing the ETN, you should be fine. It's going to track the silver price. It's going to be perfectly acceptable. Just realize that if the bank goes down, you can't go and say, "Where's my silver?" like you can with Absa's new gold ETF, where you can say, "I want my gold," and they'll give you the gold. So that's quite important, just to understand the counterparty risk on any ETNs that you're looking at, or you just trade it. I mean, yeah. So silver, I don't know, like gold as a hedge, like I kind of have always bought into. Silver, like I don't know, I haven't, and I probably should have, but because I mean, look at the precious metal run that we've had at the moment. But for me, gold has always been like it's been like an established hedge. Central banks are buying gold; they're not buying silver, and I think that's maybe gold is recognized as kind of like a financial hedge asset. It's kind of like the original currency. It's slightly different. I don't know, maybe Bitcoin or Ethereum or one of the cryptos will kind of replace it. But yeah, silver, nothing wrong with the ETNs. Just know what you're doing and what you're buying would be my advice. What's the handle of the YouTube channel? I think it's just Rand Swiss. Yeah, so I think it's just www.youtube.com/Rand Swiss, and that's it. And then you go check it out. And like I said, lots of new content because we've got a whole lot of new analysts. So I'm looking forward to when they start getting up and running once they're through all their training and all of that. So exciting times ahead. Cool. And with that, thanks a lot. As usual, I'm way over time, but I hope you enjoyed it. If you've got any questions, just pop me an email. I'm generally quite accessible. So thanks all, and I'll see you at the next one.